Good morning, folks. My name is Joe Bloodgood. I'm with Boulay Financial Advisors. With me today is my colleague, Nathan Faith. Nathan and I today are going to be discussing financial lines of defense, and we're excited to be with you. Nathan, there's been a lot of things going on, clearly. Why don't you just give us a little overview of some of the things we've been talking about with our clients when it comes to these lines of defense?
Yeah, thanks, Joe. Lines of defense are strictly just that. The term is sourced from a military term. Basically, every army has lines of soldiers, whether it be in wars of medieval times all the way up to modern times. If one line is breached, there's usually 3-4 sets of troops, tanks, artillery backing them up. And a battle isn't lost if they bend. It's only lost if they break. So same goes with protecting our wealth, our net worth, our financial plan is to have lines of defense, really sources of cash when we need it if we run into experiences like we do now.
So Nathan, one thing I've been noticing is clients are asking, how do you prioritize those things? There's different ways to find the cash, different sources, but how can we help folks know what's the best place to go?
Yeah, so we have a order of operations, a step-by-step model to follow. Not everything's always prioritized exactly the same for each person, but we always start with the main line of defense, which is cash at the ready, cash in the bank through what's called an emergency fund. And typically we recommend that folks set aside 6 to 12 months of cash in their checking or savings account. Don't worry about the interest rate that you earn. Have that at the ready so that if you experience a large medical expense, a layoff, something shocking and significant, that you don't have to do anything drastic, meaning use your credit cards or payday lender or sell something that is worth a lot less than it once was, to get you through that initial phase of a financial hiccup.
Yeah, absolutely. So these have been interesting times. So, two scenarios. One, maybe you were a little underprepared on the cash side, or two, maybe you went through it quicker than you thought. What's the next one? What's step two?
So step two is most of us own a home, and we've lived in it for a while, and we own a large enough share in that home to be able to access our ownership, the cash that we've built up, if we need to. Now, we don't recommend that folks use what's called a home equity line of credit unless they've exhausted or nearly exhausted the cash that they have in the bank. But it's a wonderful insurance policy against surprises, where if you need to bridge a large expense or a layoff, you can by borrowing from the bank at a relatively low interest rate to get you through that experience until you can come out the other side, pay off your temporary loan from the bank, and start to replenish your emergency fund.
Nate, quick question on that. Is that a line that's important to get when you don't need it, or do folks have access as long as they have home equity?
It's a great point. So banks are notorious for lending money or providing capacity to borrow when your finances are great and you don't need it. They're not so great at doing that when you experience a financial shock. So they're not the type that'll hand out umbrellas when it's raining. So we'd recommend set a home equity line of credit up while things are good, well in advance. You can get them set up thereafter, but banks require more stringent underwriting and higher credit scores and the like.
That's a great point. What's next on our list?
Yeah, so the next one's the typically the biggest, most solid, longest running line of defense, and that has to do with how our wealth, our portfolios are positioned. So by and large, most of us, especially as we approach retirement, have a very large allocation to ballast within our portfolio, safe places being cash and bond allocations. Your typical retiree has a fourth to a third of their investments in bonds, which tend to hold up well in this type of environment. Joe, would you want to speak a little further to?
Yeah, no, I think that's a great point, Nate. I think, diversification and, appropriate asset allocation is different for each investor. It's unique to their situation. And diversification doesn't always feel so good when things are going well. It usually means you're trailing whatever it is that happens to be the hottest index at that particular time, because you're spreading your risk across different investments and different vehicles. But times like this are when it's really important and really beneficial for folks who have that diversification within their portfolios. We've seen it recently where the market's been quite volatile, but the safest spot of the portfolio has historically been fixed income, and that's held up most recently too. It just gives folks, to your point, Nate, a chunk of money that they can tap so that they don't have to sell an asset that's depreciated in value. So yeah, that's great. So we've gone through emergency fund, we've gone through home equity, we've talked about using your fixed income or the bond portion of your portfolio. What's next on our list?
Yeah, so the next one on our list is one that isn't often thought of, but many folks have this tied to their taxable accounts, and it can come in handy during some unique environments. So you think of your bond allocation, your typical retiree has 3 to 8 years worth of expenses in their bond portion of their portfolio. But what do you do if, say, the bond market temporarily freezes up like it just did a month ago, meaning they fell in value significantly because no one wanted to buy bonds off of someone who was selling them to raise cash? That's where the next line of defense, called a margin loan, is available. So all a margin loan is using your investment account, like your home, as collateral to borrow from the big investment house that holds the account until you can bridge that cash flow gap. So if you don't want to sell something within your portfolio because it's down, you can temporarily borrow to a small degree in order to get you through that time frame. Or if, say, you don't have bonds built up because you're young and you're accumulating, or your bond allocation has been exhausted, you can draw from this source if need be.
Nate, once we've exhausted those, what's next on our list?
Yeah, so then we start moving into accounts that typically are meant for retirement, but all those accounts have safety valves for time frames in which we as a country or we as individuals run into a pinch. And so the first is a 401k loan. So Joe, you being a 401k expert, I'll let you speak to that.
Yeah, I would say I get this question a lot from 401k participants, and there's a reason there's a reason it's fifth on the list, but it also can be a viable lifeline in times of need. And so basically how a 401k loan works, if your plan allows for it, so each plan is unique, some plans allow for it, some don't. If your plan allows for it, you're able to borrow money from your 401k account. The plan administrator essentially creates an amortization schedule, and you pay that loan back, typically over a 5-year period, essentially paying it back to yourself with interest. The interest rate is typically 1 or 2% over the prime rate. So the good part is it's quick, it's easy, and you're essentially able to pay yourself back. The downside of it is you're taking dollars out of your retirement account, which are typically earmarked for the long term. They're no longer able to work for you while they're out of the account, and you're paying them back with after-tax dollars, only to be taxed again in retirement. So there's a little bit of, there's two sides to the coin with 401k loans, but they do provide some liquidity in case you need it potentially. Typically, you can borrow up to $50,000 or half of your vested account balance, and there may be some additional capacity, again, depending on your plan, in light of the CARES Act that happened recently. So check with your plan administrator if that's a possibility. What's next, Nate?
So the next item is directly related to 401k loan. It's actually an IRA loan. And the reason why loan is in quotes is because the CARES Act, so the government stimulus that was passed, provided a short-term loan feature in which someone can borrow up to $100,000 from their IRA this year due to the COVID crisis. And they don't pay taxes or penalties upon lending themselves the money. And if over the next 3 years, so 2021 through 2023, they repay their IRA evenly over those years, it's like the money never really left. Again, it's a ways down the list for the same reasons as the 401k loan. Your investments have to be sold in order to lend money out to yourself, and you're out of the market. And so we would prefer that you not have to go this far, but of course, if you've exhausted items 1 through 5, this is a resource for you.
Yeah, that's great. Thanks. So we've gone through 401k, we've gone through IRA. What would be next?
Yeah, so the next item is also a retirement account that we just don't have as much control over, but we've all been funding towards for our working lives, and that's Social Security. It's a wonderful resource and actually a flexible one, in which a little known fact is Social Security can actually be turned on and off for retirees, especially if they're running into a personal financial episode. So for example, anyone who hasn't yet claimed their Social Security benefit can claim it at any time. If within that first year they recover their cash flow and they no longer need Social Security and would rather have it be deferred and continue to grow for them, they can repay what they received over the course of that year. If after full retirement age, which for most folks is age 66, they claim their Social Security benefit and say wait an extra year or 2, they can turn off their benefit at any time. So it's a wonderful resource to use that is completely agnostic or uncorrelated to what the markets are doing, bond or stock.
Yeah, that's really interesting. So many of our clients, I think, initially think Social Security is really straightforward and vanilla, but there are a lot of nuances like that are worth checking out. What's next on our list?
So next on our list is a wonderful account for healthcare expenses, being a health savings account. The reason why it's far down our list is because it is the best account when it comes to lifetime tax savings. You never have to pay taxes on any dollars that are contributed or distributed from these accounts as long as you use them for most any healthcare expense. What's interesting is our recommendation to most clients is if they can pay for their medical bills out of, say, the first bucket, their checking and savings accounts, to actually allow their dollars in their health savings accounts to be invested and grow over time. However, they'll have healthcare expenses throughout their lives, and during a cash flow crunch, they can actually reimburse themselves for several years worth of past healthcare expenses and come up with a fair amount of cash out of their HSA to really get them through a pinch.
Nate, is that something that everybody should be saving all their medical receipts for that purpose?
Yes, yeah. That's how you prove to the government, the IRS, that you qualify to reimburse yourself. So it's good to keep good records. But as long as you have those receipts, you can reimburse yourself with cash from an account like this, and it goes right into your checking account.
So it's a function really of the dollar amounts being matched up, not like the specific transaction and time.
Exactly.
Got it. That's great. Well, I think that's almost it, but we have one more on the list. Why don't you take us home? What's the last one, Nate?
So the final one is related to health savings accounts. The second best type of account to have money in long-term are Roth IRAs. They're tax-free accounts, for your lifetime and for your kids. And by and large, we recommend clients not draw from these accounts unless they have to. However, young, old, anything, anywhere in between, what's interesting with Roth IRAs is you can always withdraw dollars that you put into the accounts at any time, no questions asked, no taxes, no penalties. And that's why they are a wonderful line of defense for folks who, say, have exhausted the previous options. Know that they built this resource, they've sacrificed to fund their Roth IRAs, and if need be, they can help be that penicillin to solve some of their near-term cash flow needs.
Yeah, that's great. I know Boulay Financial Advisors has a strong opinion around Roth IRAs for some of these same reasons, right? All the things you talked about, all the potential benefits. Just a great account. If you don't have one, look into how you might set one up. Well, thank you, Nate. This has been great. We appreciate everyone's time. Next week, we're going to be talking about wealth management order of operations. So today we talked about lines of defense. Next week, we're going to talk a little bit about how you start making progress on your wealth management or financial plan and how you would order those operations. Thanks so much, Nate. We'll talk to you soon.